Hi everyone and thank you for joining us. Today we are stepping into the engine room of the financial system, not just to understand how banks and payments work, but to unpack the legal scaffolding that keeps everything running smoothly. As legal professionals, we'll be guiding you through key aspects of banking and finance law, focusing on how legal frameworks uphold the integrity, efficiency and fairness of financial transactions. We'll move from traditional paper-based instruments to the rapidly evolving realities of digital banking, real-time payments, and consumer risk. Together, we'll show you that banking law isn't just rules on paper, it's what makes commerce possible. It protects consumers, empowers lenders, and ensures that when money moves, there's a clear legal pathway behind it. Let me introduce our roadmap for today. I, Devina, will begin by exploring the banker-customer relationship, a legal foundation that governs every deposit, withdrawal, and online transfer. Whether you are tapping your phone at a cafe or wiring funds to another country, this relationship defines the duties, rights, and liabilities between banks and their clients. After that, I'll hand over to Mihir, who will dive into bills of exchange and discounting.
A centuries-old tool that still plays a vital role in commercial, finance, and trade law. I'll explain how these instruments work, their legal requirements, and why they remain relevant even in today's high-speed financial world.
Then we'll hear from Nikhita, who will broaden the conversation by examining negotiable instruments,
including checks, promissory notes, and letters of credit, and how they each carry unique legal implications in both domestic and international banking.
Finally, Adrika will close our session by turning the spotlight on consumer protection.
To wrap up, I will be turning the focus onto consumer protection, specifically how the law is responding to unfair contract terms in banking and financial services. I'll take you through the impact of the November 2023 UCT reforms, key court decisions, and how regulators like ASIC and the AFCA are driving a shift towards proactive fairness and accountability in standard form financial contracts.
By the end of this session, we hope to leave you with a clear understanding that banking law is not just about compliance, it's about legal engineering. It's about creating systems that distribute trust, manage risk, and support fair economic relationships, all through enforceable legal principles. Now let's begin where all the banking commences, that is, with the relationship between a bank and its customer. Good afternoon, Neil. We are here today to provide a legal consultation, and we understand that you are currently dealing with concerns surrounding how banks handle instructions, funds, and financial data in light with a recent incident involving an unauthorized transaction that you incurred. My name is Devina and I will be leading this session. I am joined by my colleagues Nikhita and Adrika, and together we are legal professionals working in banking and finance law. Nikhita and Adrika, Mir, have asked us to explain his rights and the obligations of banks under Australian law, particularly focusing on the banker-customer relationship and how this relationship is impacted by modern banking technologies. Throughout this presentation, I will take the lead in explaining the key legal principles and case law. Nikhita and Adrika will support this session by explaining some practical examples to you, Mir, so be free to ask us any questions that may raise concerns drawn from your recent experience. And we will provide clear legal advice and guidance, so let's begin. Let us start with the core question: what is the banker-customer relationship in law? The starting point lies in the decision highlighted in Foley versus Hill, where the House of Lords established that when a customer deposits money in a bank, the money becomes the property of the bank. The bank does not hold it in trust. Instead, the relationship is that of debtor and a creditor. The customer is a creditor with a right to repayment, and the bank is a debtor with an obligation to repay the amount on demand. As Professor Tyree explains in Banking Law in Australia 2023, this relationship is not fiduciary unless special circumstances arise. It is primarily contractual in nature, meaning that the terms of the contract govern how the account operates. The implication is that banks are not automatically liable unless they breach express or implied duties contained in that relationship. Yet, despite its contractual foundation, the relationship is subject to higher standards. Banks must meet obligations that include repayment, adherence to instructions known as mandates, exercising reasonable care, and complying with regulatory obligations under instruments like the Banking Code of Practice. While most of the legal principles governing the banker-customer relationship come from common law, it's also important to recognize the statutory frameworks that underpin banking operations in Australia. For example, the Banking Act 1959 regulates authorised deposit-taking institutions and empowers the Australian Prudential Regulation Authority to supervise bank solvency and customer protections. Meanwhile, the Electronic Transactions Act 1999 enables legally valid digital contracts and instructions, which is critical when banks rely on mobile apps or online portals to process customer directions. These laws work in tandem with common law duties to create a dual-layered legal environment, one based on contracted care and the other on statutory compliance and consumer protection. This legal foundation is what allows the banking system to function with predictability and trust.
I recently tried to withdraw funds from my own deposit early, but the bank refused. I thought it was my money. Can they do that?
That is an excellent question, Mihir. The first legal duty of a bank is to repay funds held in a customer account, but this duty only arises when a valid demand is made in accordance with the account terms. This principle was clarified in Johansson versus Swiss Bank Corporation. In that case, the court held that the bank's obligation to repay arises only upon a proper demand made at the branch of deposit during banking hours. While this may sound outdated, the principle still applies in substance, especially when we consider product-specific terms. In your situation, Mihir, if the term deposit is fixed for 6 months and you attempt to access it earlier, the bank is not legally obligated to release the funds unless the terms of the product allow for early withdrawal. Your right to repayment depends on the contract you agreed to. This is why the bank was within its rights to decline the request. So the key takeaway here is that the right to repayment is not absolute. It depends on whether the conditions of the account permit the type of demand made.
I also instructed my bank to transfer funds overseas, but I later realized it was a scam. Can the bank be held responsible for following my instructions?
This brings us to the second major duty, the obligation to follow the customer's mandate. A mandate is any instruction given by the customer regarding how the bank should handle their funds. While banks are generally required to comply with mandates, they are not expected to do so blindly. In Barclays Bank versus Quincecare Limited, the court held that banks have a duty to refrain from executing a payment instruction if they have reasonable grounds to believe that the instruction is an attempt to defraud the customer. This is known as the Quincecare duty. In Australia, while this principle has not been adopted in all jurisdictions, the Queensland Court of Appeal in Westbank Banking Corporation versus Jamieson noted that a bank may be liable if it follows a mandate in circumstances where it was aware or ought reasonably to have been aware of suspicious conduct. In your case, Mihir, if the transfer was uncharacteristic and significantly larger than your usual transactions, and if there were indicators of fraud, the bank could have a duty to pause and investigate. If they failed to act despite the red flags, you may have grounds to claim breach of this duty. However, if the transaction appeared normal and was confirmed via secure credentials, the bank's liability diminishes.
Let me add to this with another duty that overlaps with the Quincecare principles. The bank's duty to exercise reasonable care and skill. This duty arises under common law and is reinforced by Clause 10 of the Australian Banking Code of Practice 2023, which states that a bank must act with the care and skill of a diligent and prudent banker.
Thanks, Adrika, for explaining the law. Now let us take the example of a small business owner who uses a corporate email to communicate with the bank. A hacker compromises the email account and instructs the bank to transfer $60,000 to a new payee. The bank, without verifying this change, processes the transaction. The question arises, did the bank act with due care? Did it have systems to flag sudden changes in payees or unusual transfer amounts? If not, even though the mandate was facially valid, the bank could be in breach of its duty to act prudently. However, courts will also consider whether the customer used secure channels and whether their conduct contributed to the breach. This introduces the principle of contributory negligence.
The rise of real-time banking has added new challenges. Under the new payments platform, payments are processed instantly, leaving no window for fraud detection or recall. Consider a customer who receives a fake invoice that appears genuine. They process the payment using their customer ranking app, only to later discover it was fraudulent. The bank, having followed correct login credentials, refuses liability.
Thanks, Nikhita, for highlighting those facts. So, Mihir, in National Australia Bank Limited versus Hockett Private Limited, the court upheld that the bank was not liable when it processed an authenticated instruction that was later revealed to be fraudulent. Legally, that position is sound, but from a consumer perspective, it highlights a gap in protection. Australia is still exploring these reforms similar to the United Kingdom's 2024 scheme that mandates reimbursement for certain push payment frauds. These developments show that the law is still evolving. Now, let us consider a related but distinct aspect, the risks associated with open banking. Under the Consumer Data Right regime, banks are required to share a customer's financial data with accredited third parties, but only with informed and express consent. The consent must be specific, time-bound, and revocable. The legal risks arises when the data is compromised in transmission or misused by the third-party provider. As Bragg notes in Banking and Financial Institutions Law 2020, this creates a shared liability framework where multiple parties may be partially at fault. If Mir instructs his bank to share data with a budgeting app and the app later suffers a data breach, the bank would still be liable if it failed to verify the app's accreditation or security protocols before transferring the data. Banks must therefore maintain rigorous compliance with CDR obligations, including secure data handling and full disclosure to customers about the risks involved. As technology advances, the nature of authorization is also being tested. Imagine a customer authorizes a payment using facial recognition, but a deep fake or stolen biometric data is used instead. Or consider when an AI-powered chatbot mistakenly processes a transfer request based on poor language interpretation. In both the cases, the bank may argue that the system worked as designed, but legally, the question arises, was there informed, intentional consent? These risks highlight the growing tension between automation and accountability, particularly in a world where the law is still catching up. How artificial intelligence and biometric systems operate in financial services. Let us now bring all these concepts together in a real consultation context. Mir, our client today, owns a growing media business. He recently transferred a large sum of $150,000 to what he believed was a long-term supplier. Everything in the email seemed correct, same signature, branding, tone, and urgency. However, the email was fraudulent. The supplier's email system had been compromised and the bank details were replaced by the hacker. Mir's accounts officer, unaware of this manipulation, processed the payment through the company's online banking platform. The bank authorized the transaction based on login credentials and past transaction habits. When Mir discovered the fraud 2 days later, he contacted the bank. The bank replied, "We followed an authenticated mandate."
Can I recover the money or can I sue the bank?
Let's work through this, Mir. The most important question arises is, was the customer's mandate followed? In a technical sense, yes, the bank received an instruction via the correct login, authenticated through normal digital channels. However, banking law imposes a duty on the bank not to act blindly, as we explained earlier with reference to Barclays Bank versus Quincecare and its development in Australia through Westpac versus Jamieson. Banks may be liable where they ignore suspicious or inconsistent instructions. We need to ask, was this transaction out of character? Did the account suddenly send a large payment to a new overseas recipient? If so, the bank may have a duty to pause and verify. If it failed to detect these red flags, there could be a breach of the Quincecare duty or the broader duty to act with reasonable care and skill under common law and clause 10 of the Banking Code of Practice. Was there a breach of the duty of care? Let us consider the standard of a diligent and prudent banker. The High Court has not precisely defined this but common law gives us guidance. Banks must act with care to prevent foreseeable harm. Clause 10 of the 2023 Code of Practice explicitly requires that banks exercise care and skill in all dealings with the customers. In Mihir's case, a diligent bank should have had systems to detect anomalies such as a large first-time international payment or a change in beneficiary details. If no warning was triggered or no human verification took place, the bank may have failed to act prudently. As Edgeworth highlights in Australian Commercial Law 2020, this is not about being perfect, it is about acting reasonably in the context of automated banking systems. So was Mihir contributory negligent? We must examine whether Mihir's own system failed to protect against fraud. Was there a protocol for verifying new payment details? Was staff trained to identify the red flags? If the accounts officer did not confirm changes to supplier information via an independent method, the court may reduce Mihir's recovery on grounds of contributory negligence. This aligns with the recent cases that balance institutional and customer responsibilities. Were any third-party systems involved? If Mihir used a third-party payment processor, invoice automation tool, or a budgeting app, and if the fraud occurred due to a vulnerability in that software, then liability may be shared. Under the consumer data right regime, accredited providers must meet strict security standards, but legal responsibility still depends on who failed to protect the customer's interests. So we can see that Mihir's case requires a prolonged legal analysis. The bank may be liable for ignoring red flags. Mihir's internal failures may amount to contributory negligence. A third party could also be partially responsible. Ultimately, the resolution could involve negotiation or litigation, depending on whether the bank met its legal and procedural obligations under statute, case law, and industry codes. To summarize, the banker-customer relationship is legally defined as a contractual debtor-creditor relationship, but it is overlaid with additional duties. First, to repay on demand subject to proper demand procedures. Second, to follow mandates but not blindly, especially where there are fraud indicators. Third, to exercise reasonable care and skill. And fourth, to manage data responsibly under the consumer data right framework. In a world of automated banking and digital risk, legal duties must evolve to ensure both trust and accountability remain intact. That concludes our analysis of the banker-customer relationship and its evolving legal duties. Meaning, now that we have explored how your rights and protections work with the banking framework, it is time to examine another financial instrument that plays a central role in commercial transactions, that is, the bill of exchange. To guide us through how bills of exchange operate in law, including their use in discounting and trade finance, I now hand it over to you, Mihir.
Thanks, Adrika. Adrika, would you help me as a role of a client who's expanding her business, stepping into larger supply contracts, possibly importing raw materials, or entering credit-based agreements with overseas partners? These are the major steps with it comes one of the biggest challenges in trade: how to get paid or make payments, security across time zones, and legal systems without risking everything. This is where legal tools like bill of exchange come in. And they aren't just paperwork, they are core infrastructure in the machinery of trade finance. In fact, the very reason negotiable instruments exist is to facilitate trade by reducing uncertainty. Whether you are dealing across borders, extending credits to customer, or discounting receivables to fund operations, negotiable instruments, especially bill of exchange, are what allows businesses to operate on trust without requiring immediate cash exchange.
So, Mihir, you're saying that bills of exchange are basically like credit instruments backed by legal force?
Exactly, Nikhita. And that legal force is precisely what makes them powerful. When structured properly, a bill of exchange becomes more than just a promise. It becomes a legal enforceable obligation that can circulate like money. Let's ground this in law before we dive in. In Australia, The governing legislation is the Bill of Exchange Act 1909. Under Section 8(1) of Bill of Exchange is defined as an unconditional order in writing addressed by one person to another, signed by the person giving it, requiring the addressee to pay a sum certain in money or on demand at a future time or to a specified person or bearer. That one sentence captures a whole world of commerce, because every phrase in it is a legal requirement that gives the instrument its power and reliability. Now, here's the commercial reality, Adrika. When you enter into a supply agreement, you'll often want to offer credit terms to buyer, say pay me in 30 days, or your overseas supplier wants payment now, but you can't afford until the goods arrive and generate revenue. This is the trust gap. You don't want to pay upfront without assurances. The other side doesn't want to pay without a guarantee. This is exactly where Bill of Exchange comes in to bridge that gap. They are designed to function like a legal IOU, but stronger. Once drawn and accepted, a Bill of Exchange carries enforceable obligations independent of the underlying contract. Now, why law favors these instruments? Legal scholars point out that the entire design of a bill of exchange is to separate legal documentary value from the messy realities of a contract. If a bill meets the formal requirement, it becomes an enforceable instrument on its face without needing to prove anything but the deal that led to it. That's why they are trusted globally, because they bring together three things every trader needs: predictability, transferability, and anomaly. Now, let's see how this happens in a trade application. How this will help you, Adrika. Let's imagine this. You purchase $50,000 worth of specialty goods from an Indonesian supplier. You negotiate a 60-day credit period. Rather than just hoping you will pay on time, they ask you to issue a bill of exchange. Once issued and accepted, the supplier can either hold it and collect the full amount in 60 days, or sell it at a discount to a local bank, get immediate cash, and the bank collects full amount later. That's trade in motion. And the legal engine driving it is the bill of exchange. No need for cross-border lawsuits or escrow agreements. The instrument itself does the heavy lifting. Adrika, now that we have seen how bill of exchange help move money through trade, let's focus on what makes one legally valid. This is crucial, because even one requirement is missing, the document becomes legally useless. So, for a document to qualify as a bill of exchange under Section 8(1), it must be an unconditional order. It must be in writing and signed. It must be addressed by one person to another. It must be for a sum certain in money. It must be payable on demand or at a fixed time, and made payable to a named person or bearer. Each of these requirements isn't just technical, they serve to ensure predictability and transferability. Even if one element is missing, you risk its enforcement rights, ability to transfer the bill, and there's zero protection under the Act. In trade, that's a major risk. Let's unpack these essentials quickly but carefully. First, we'll be looking at an unconditional order or sum certain. Let's take two of the most commonly misunderstood elements: unconditionality and certainty of amount. The bill must clearly state the amount to be paid, and it can't depend on any outside condition. In club securities, a bill said payout of the Corabas Trade Fund. The court held it invalid because it relied on an uncertain condition. Similarly, in Rosenheim, a bill included interest until funds arrive in London. Again, rejected. The amount wasn't fixed at the time of issue. So, Adrika, if a supplier gives you a bill, let's say pay $15,000 plus customs, if any, would you know your total liability?
Not really. I'll probably ask them to confirm it.
Exactly. That's why the law requires the figure to be fixed on the face of the bill. No surprises. Next, the bill must be in writing, signed and addressed. These are the basic formalities, but the bill must be in writing, signed by the person ordering payment and addressed to another party. Section 11 covers the drawee must be clearly identified, otherwise no one knows who's being ordered to pay. And as per sections 10.2, if the drawer and the drawee are the same person, it's not a bill at all. It becomes a promissory note.
So Mihir, let's say Adrika draws a bill but forgets to sign it. What happens?
That's a great example. Without a signature, there is no obligation. The bill immediately fails. It's not enforceable. Next, the bill must contain a sum certain and not a fluctuating or uncertain amount. Again, in Rosenheim, the bill added interest until funds arrived in London. The High Court struck it down. Too vague. Section 14, 15 and 16 also requires that the bill be payable either on demand or at a determinable future time, like 30 days from issue. So, if I say, pay when I get paid is not a valid timeline, it creates uncertainty, which the Act strictly avoids.
So if Adrika wants to sell a bill before maturity, say to get quick cash, she needs to ensure it's payable to order or bearer.
Exactly. That's what allows the bill to legally change hands and ultimately be enforceable by whoever holds it. And the last condition, payable to a person or a bearer. Section 13 covers it. A bill must be payable to either a named person, say Adrika Private Limited, or the bearer, meaning whoever holds it. This ensures the bill is transferable, which is the key to its use in trade. Now, legal scholars call the Bill of Exchange a self-contained legal promise. It's a promise. Its power lies in clarity and form. If the recipient has to investigate what it means, it already fails its function. Now that we have seen how to structure a valid bill of exchange, let's move to the next step. What happens when the bill changes hand? Because in business, it's not just about making promises. It's about whether someone else can rely on that promise and enforce it later. That's where negotiation and the holder in due course come in. Alright, Adrika. We have covered that what makes bill of exchange legally valid. But here's the real trade advantage. It's negotiability. Bill of exchange don't just bind the original parties. They're designed to circulate, to be transferred, sold, and used as a near cash instrument. That flexibility keeps businesses like yours keeps moving, especially when credit terms are involved. But how does the law protect someone who receives a bill they didn't originally sign or issue? That's where the concept of holder in due course comes in. And it's what makes a bill of exchange one of the most insecure instruments in global trade. Now, imagine this, Adrika. You issue a bill of exchange to an overseas supplier payable in 60 days. You don't want to wait 2 months to get paid. So they transfer the bill of exchange to a financier or a bank at a discount. That party is now the new holder. But what if you later discover the goods were defective? Can you refuse payment? Not if the bill is in hands of a holder in due course. That's the whole point, to ensure certainty in payment system. Once a bill of exchange is properly transferred to a third party acting in good faith, they take it free of prior dispute. It functions like cash. Now, here's the legal test. Under section 34(1), a person becomes holder in due course if they take the bill for value, in good faith, without notice of any defects in title, and before the bill becomes overdue. Once these 4 conditions are met, the holder gains a clear title and is legally entitled to enforce payments even if there were issues in the underlying contract.
So even if the original deal was flawed, the new holder still gets paid?
Exactly, that's the policy rationale to protect trust and liquidity in trade finance. It's not just about fairness between original parties. It's about giving commercial certainty to those who rely on instruments at face value. Otherwise, every bill of exchange would be a potential legal trap. Which brings us to the case Nova Jersey Net. In this leading case, the buyer refused to honor a bill of exchange, claiming the delivered goods were defective. The bill had already exchanged hands and to a third party holder who had no knowledge of the dispute. The court upheld the bill, not because the goods were not perfect, but because the negotiability of the bill must be preserved. The third party took it in good faith and without notice of any defects. They were protected under law. Let's put it in your business context. You import furniture from a Vietnamese supplier. You agree to pay $60,000 in 45 days and you issue a bill of exchange. The supplier, needing fast cash, sells the bill to a Melbourne-based finance firm for $57,500. They meet all the four conditions. They paid value, acted in good faith, had no notice of defects, and took it before maturity. Now suppose 30 days later, you find that some goods were damaged in transit. Can you stop payments? Legally, no. The finance firm is a holder in due course. Your remedy, if any, lies with your supplier, not with the new holder of the bill. Now, lastly, some legal insights. The holder in due course rule exists to ensure that commercial paper can be used like money. Businesses rely on being able to turn receivables into cash without risk. If transferees were always dragged into prior disputes, nobody would touch a bill of exchange. By cutting off most defenses, the law promotes speed in transactions, market liquidity, and trust in negotiable instruments.
Are there any limits to this protection? Like, what if the bill is forged or already dishonored?
Even a holder in due course can't enforce a bill if tainted by certain absolute effects. These includes, first, forgery. If the bill contains a forged signature, it's void under Section 28, even in the hands of an HTC. Second, material alterations. If someone changes the date, amount, or terms without consent, the bill is invalid under Section 64. Next, overdue instruments. If the bill was already overdue when transferred, the holder doesn't qualify the HTC protection. You can see Section 52. And last, actual knowledge of defects. If the transferee had no notice of any defects, frauds, dishonor, or illegality, they cannot claim the HTC status. Now, the landmark case for this is Greenwood. In this, the case involved forged checks by a wife. The husband knew about it but remained silent. When he later sued the bank, the court held he was stopped because his silence had got the bank on relying on what appeared to be genuine. The message for modern commerce is clear. Negotiable instruments rely on trust. If a party contributes to a false appearance, the law may still hold them responsible. Now, here are your final key takeaways for your business, Adrika. So as you expand, here's what you remember about negotiation and HTC. If you issue a bill, ensure it's free from any defects. Once transferred, you cannot claw it back. If you receive a bill, check its status. If you meet the Section 34 test and you gain powerful legal rights. If you are discounting a bill, make sure you are within the maturity window and unaware of any disputes, and you will be protected. This is how a bill of exchange facilitates trade. They allow value to move freely, securely, and reliably across markets. Now that we have understood how rights can be transferred under a bill of exchange, let's take one step further. Let's talk about circulation. Adrika, now that we have seen how a valid bill of exchange protects its holder under the law, let's explore how these instruments actually move through commerce. Because the bill you issue today to a supplier may tomorrow be held by a bank, a factoring aid company, or a third-party investor. This movement is what makes bill of exchange more than just a promise to pay. It makes them transferable financial instruments. Now, if a bill of exchange is considered a negotiable instrument, meaning it can be transferred to others either by delivery, if it's payable to a bearer, or endorsement and delivery, if it's payable to order. This is governed by section 36 to 39 of the Bill of Exchange Act. Let's break this down. If the bill says pay to bearer, then whoever holds it can present it for payment. Transfer is as same as handing it over. If it says pay to Adrika Private Limited or order, then Adrika must endorse it. That is, sign it back to pass it to someone else. The system enables the bill to function like documentary currency. It can pass through multiple hands before maturity, providing commercial flexibility and legal enforcement at each stage. Let's say you receive a bill from a buyer in Singapore payable in 60 days. You want to transfer it to your logistics partner here in Melbourne as part-time payment for freight services. If it's an order bill, you sign that back, pay ABC freight or order, and hand it over. The logistic company becomes a new holder and can enforce payment from the original Troy in Singapore. And legally, they don't need to know about the backstory. If they meet the condition for good faith and value, they can enforce it like cash. Let's talk about statutory presumptions. Under section 27(1), the law presumes that every holder of a bill is a holder in due course, unless proven otherwise. And section 26(2) makes it even stronger. If a bill is in hands of an holder in due course, it's conclusively presumed to have been properly delivered and validly issued by all prior parties. What does this mean in trade? It means that when your business receives a bill, you don't have to conduct forensic audits of every endorser before you. The law gives you protection, and that's what keeps negotiable instruments usable at scale. Right. Now I'll talk about legal consequences of endorsements. Anyone who endorses a bill, including you, Adrika, if you transfer one, is legally on the hook. Section 62 tells the endorsers warrants that the bill will be paid on due presentation and promises to compensate the holder if it's dishonored. This creates legal accountability across the chain of possession. Anyone who touches the bill has the skin in the game. Lastly, I'll talk about negotiability as a trade infrastructure. Commercially, this system archives something powerful. It allows for credit to be converted into capital. It builds trust across jurisdiction and time delays. And lastly, it lets parties trade risk while keeping legal enforceability intact. So, Adrika, it's important to know that not all bill of exchange are treated equal. The type of bill you use affects how easily it can be transferred, enforced, and relied upon in commerce. That brings me to end of my discussion on bills of exchange. And now it's my pleasure to introduce another brilliant member of our panel, Nikhita, who will take you forward from here. What she'll be about, what she's about to explore, well, you're about to find out. Over to you, Nikhita.
Thank you, Mihir. Hello, everyone. My name is Nikhita, and I have the honor of taking this legal baton from my learned friend Mihir, as he has already laid down a brilliant foundation on bills of exchange, being nothing short of a maestro in the subject. And he has already explained things with great clarity. He remains ever watchful and most welcome to jump in or question me if I happen to stray even slightly while carrying away forward his legacy. I'll now guide you through the different types of bills of exchange. So let's dive in. First in the line is inland bill, which is covered under section 9 subclause 1. An inland bill is a bill of exchange that is written or drawn and also meant to be paid within Australasia, like Australia or New Zealand, or it looks like it was made inside Australasia and is directed to someone who lives there. Now comes in accommodation bills, which are covered under section 33 subclause 1. An accommodation bill is when someone It can be the drawer, acceptor, or endorser signs the bill without getting any money or value in return. Why? Just to help someone else out, usually to support or finance the person who actually needs the money. Think of this person like a guarantor. They are backing up the bill and agreeing to pay if needed when it's due, even though they didn't benefit directly. Then we have inchoate bills, which is under section 25. An inchoate bill is an incomplete bill of exchange, like a partly filled form waiting to be finished. Here's when someone can be held legally responsible for it. Here's when someone, they must have signed a blank but properly stamped paper, meaning stamp duty is already paid. Given it to someone with the intention that it would be completed later as a proper bill. If we see these bills in the context of business, trade or commercial bills coming. These are bills of exchange used in real transactions, unlike accommodation bills, which are more like favors. If the bill is used to buy or sell, it's called a trade bill. And if the bill is used to borrow or lend money, it's called a commercial bill. Lastly, we have bank bills. A bank bill is a bill of exchange that's either accepted or endorsed by a bank. If the bank accepts the bill becomes the main party responsible to pay when the bill is due. And if the bank endorses the bill, the bank only pays if the main party fails to pay.
I'm still a bit unclear on how the legal liability of parties differ between an accommodation bill and a bank bill, and why does this difference matter in commercial practice?
In an accommodation bill, a party signs without receiving value, acting as a guarantor to help another party. Liability depends on the creditworthiness of the accommodated party. In a bank bill, a bank either accepts, which makes it primarily liable, or endorses, which makes it secondary liable. If I simply put, bank bills are seen more reliable, so they carry risk, greater market confidence, and lower discount rates, making them more valuable in trade and finance.
Well, that answer brings another question in my mind. You talked about inchoate bills. I want to understand why would anyone be held liable on that, and how does this reflect principles of consent and agency in commercial law?
Let me explain you with an example I understood from. Let's say I run a small import business and need quick credit. You agree to help. You sign a blank piece of paper that is already has the correct stamp duty paid. You hand it over to me and say, go ahead, fill in the details and use it to raise funds. I write $10,000 immediately within the stamp limit and use the bill as if you have created it. Later the bill is not paid. The holder of the bill, the person who now has it, tries to make you pay the same. So the moral of the story for you here is, when you sign a blank but stamp bill and hand it over, the law treats it as you giving permission, like appointing someone as your agent. That's where consent and agency kicks in. While I'm pleased to wrap up the topic Mihir began, I'm truly grateful to him for giving me this opportunity to speak on the types of bills of exchange. And now it's your turn once again, Mihir, and take us into the next fascinating area of discounting. Over to you.
Thanks, Nikhita. That was a clear overview of different types of bill. Now let's begin all of this together in practical business scenario. Something that might mirror what you, Adrika, could face soon. Let's say your company, Adrika Private Limited, has just secured a large supply order from a financial house in Milan. The order is worth $120,000 with payment due in 60 days. You negotiate to receive a bill of exchange drawn on the buyer, payable on maturity. You now face a decision. Do you want to wait 60 days for payment, or do you want to discount the bill to get immediate funds and fulfill another incoming order? Nikhita, if Adrika brings this bill to a local financier, say a bank or a fintech platform, what should she know before discounting it?
Good question, Adrika. The financer will want to make sure the bill is valid under Section 8. So check for all the required elements, is still within maturity, ideally it should not be overdue, has a clear chain of title, meaning you received it properly and can pass it on. If all that checks out, they will likely purchase the bill, giving you immediate cash minus a small discounting rate.
Right. And legally, the financier becomes the new holder for value and possibly even the holder in due course, depending on the circumstances. This means the buyer and vendor can't raise disputes about fabric quality or shipping delays to avoid payments. The financier is protected. That's the legal power of negotiability. Devina, if the bill was originally a bank bill, say accepted by the buyer's bank, would that change anything?
Absolutely. A bank accepted bill gives the financier even more comfort. The bank becomes primarily liable to pay at maturity. That often means a lower discount rate for you, Adrika, because the risk is reduced. It's also more liquid in the discount market, easier to sell or even rediscount.
So, you see how bills of exchange don't just record payment terms, they function as trade instruments, letting you convert receivables into cash, manage risk, and grow without relying on traditional loans. So, to close today's briefing, Adrika, my final advice. Issue bill of exchange where you want legal certainty, especially in delayed payments situations. Verify any bill you received for compliance before accepting it or discounting it. Understand the types of bill, trade, bank, accommodation. Each carries different level of risk and reliability. And don't hesitate to use discounting as a strategic tool for growth. When done properly, it's legal, secure, and commercially powerful. Now, once again hand over to Nikhita, who will talk about checks.
Thank you once again, Nikhita. And that wraps up the discussion started by this fine gentleman. Now, let me guide you further into the world of negotiable instruments onto the other key branches. My attempt will be to guide you through the nuances of checks and letters of credit, supported by detailed reasoning and well-grounded arguments. The first stop on our journey, can you guess, Adrika?
I get it. The humble paper check. Or built like the fax machine of banking, isn't it?
Exactly. Once mighty, now fading like floppy disks and pages, but still, it's important. In the sun-burnt land of koalas and compliance, the check is a paper soldier in the army of banking law. To begin, we start with the definition. You will find one in the Section 78 of the Bills of Exchange Act, but the more relevant and the modern definition comes from Section 10 of the Checks Act 1986. A check is a written and unconditional order made by one person to a financial institution, usually a bank. It must be signed and it directs the bank to pay on demand a fixed and a certain sum. No ifs, no maybes, it has to be clear, immediate and in writing.
So, no creative language? Got it.
Also, under the Checks Act, it doesn't even need to be drawn on a bank. Specifically and interestingly, it cannot be made non-transferable. And here's something technical. An instrument might fail as a check under the Checks Act, but still be valid as a bill of exchange under the Bills of Exchange Act.
Wait, how's that possible?
Let me give you an example. Say the instrument reads, pay $7,500 plus any late fees incurred. Under the Checks Act, that's a no-go. The amount is not certain. How much is the late fee? We don't know. A bank cannot guess.
So the check gets rejected?
Yes, under the Checks Act, but under the Bills of Exchange Act, it might still work. That act allows for certain variable elements like interest or charges as long as they are clearly determinable. So if the late fees is calculable by known conditions, it could pass as a bill of exchange.
Interesting. So even when one door closes, another might be slightly ajar?
Spot on. I'll whisk you back in the time for a moment. But before that, let us not overlook the quiet power of Section 73, a statutory assurance that a check, once duly presented, must be paid. Should that promise falter, the law steps in to ensure that the holder or any endorsers down the chain is made whole. Checks in Australia trace their legal roots to the Bill of Exchange Act 1909, which largely mirrored the UK's Bill of Exchange Act 1882. Over time, checks evolved from instruments used primarily by merchants to widespread tools of everyday commerce. Recognizing the growing use and need for modernization, the Manning Committee was established in 1962 to review and recommend reforms. Its pivotal 1964 report advocated for a separate law for checks, leading to proposals like the Checks Bill 1984, which aimed to clarify uncertainties, embrace new technologies like digital check processing, and simply outdated provisions.
You mean like nobody really signs the back of checks anymore?
Exactly. And now we have technology that lets banks scan and send details rather than the physical check. Now, here's where things get spicy. The problems with checks are not new. They existed decades ago and still persist. Let me give you a classic example, the Bazzacco case. Mrs. Bazzacco claimed she never received her 2 each pension checks. She asked the DSS to reissue them. DSS said, "We see they were cashed at your usual branch, signed as usual, including your husband's. You got the money."
But what if she didn't cash them?
Now, that's what the AAT had to consider. But legally, once a check is cashed, it's considered that value has been received. The burden to prove otherwise is heavy, so the DSS refused to reissue them. And the AAT confirmed it was a reviewable decision under Section 125 for Social Security Act 1991.
So basically, if it's paid and looks normal, the law says you got it?
Precisely. There was also this Barnett case where the High Court said a bank is not liable for repaying checks if it acted in good faith and in the ordinary course of business. Even if the transaction turned out to involve fraud, that case reinforces the idea that checks are only as strong as their paper trail. And while courts often protect customers from liability when forged checks are involved, as in NEB and Hockett, banks usually carry the burden. The court ruled that customers have no implied duty to detect forgeries. But if the customer's conduct amounts to ratification or causes estoppel, then under Section 32 of the Checks Act, the bank can still recover the funds.
All this makes checks sound a little fragile.
They are full of paper promises and room for mistakes, which brings us to their future. And let me show you with the help of 2 well-researched graphs for an entire decade. This is the first one. The Australian government plans to phase out checks by 2030. Use has plummeted nearly 90% in the past decade. The cost of processing them is high and they are prone to fraud. You might be surprised to learn that this was not always the case. In fact, back in 1998, during the second reading of the Checks and Payments Order Amendment Bill, Speaker Mr. Miles noted that checks usage in Australia was high by international standards.
So who even uses them anymore?
Mostly older Australians, vulnerable groups, small businesses, and some government departments. For many, it's habit or lack of access to digital tools, but change is coming. In fact, from 2025, bank checks will begin being phased out. By 2030, the whole system will shut down. The government is working to ensure a smooth transition, encouraging digital alternatives and offering support where needed.
Sounds like the check is finally being shown the door.
Gently but firmly. After all, while checks help build the banking world we know, it's time we let them retire, gracefully like old warriors of the financial system. Alright, from here I begin the last topic of the day, letters of credit. Now you might have heard this term thrown around in international trade circles, but what exactly is it? Let's unpack it. The UCP 600, that is the Uniform Customs and Practice for Documentary Credits, is a globally adopted set of rules issued by the International Chamber of Commerce. It governs how letters of credit work. A letter of credit, often shortened to LC, is essentially a financial promise issued by bank on behalf of a buyer. It guarantees that the seller will get paid provided they meet the documentary requirements. And it's mostly used in international trade. Here's how the process unfolds. First, the buyer requests an LC from their issuing bank. The LC is sent to seller's bank. We call it the advising bank. The seller ships the goods and submits documents like the bill of lading, invoice, insurance papers, etc. If everything checks out and matches the LC terms, payment is made. This can be instantly or after a time delay. The key thing? Bank deal in documents, not goods. If the documents match the letter credit, payment flows, period. Now, Devina, who happens to be my friend and client, I'll walk her through a fascinating contrast in how the courts have applied this principle of strict compliance. In J.H. Rayner and Hemrose Bank, the letter of credit required the goods to be Coromandel groundnuts, but the documents describe them as OTC, CRS, Orus, and machine shell groundnut kernels, these two terms. These were technically equivalent, but the court upheld the bank's refusal to pay because the terms did not exactly match the letter of credit.
So even though they meant the same thing, the bank wasn't wrong.
Yes, because under strict compliance, banks are not supposed to interpret. They just check the words. But in Sobroma and marine animal byproducts, the court took a different approach. The letter of credit and sales contract described the goods as Chilean fish full meal, but the invoice said Chilean fish full meal 70% protein, and the BOL said Chilean fish meal. The court said, you know what, anyone in the trade would get what this means, so strict compliance was relaxed in favor of commercial reasonableness. Although we have several types of letters of credit, for now, let's highlight two important ones. First one is commercial letters of credit used in sale of goods contract. Bank pays when seller proves performance with proper documents. The bank expects to pay because the transaction is proceeding normally. Second is standby letters of credit used in non-sale settings like construction, services or lease. Works more like a guarantee. Bank pays only if applicant fails to perform. So here the bank does not expect to pay unless something goes wrong.
So the standby letter of credit seems rare. Any major case law?
Absolutely. One of the most debated cases is Olex Forecast and Skoda Export. Here, Skoda Export tried to claim under an SPLC, even though Olex Forecast had not defaulted. The court said this goes against conscience. It ruled that this claim was statutorily unconscionable under Section 51AA of the Trades Practices Act 1974.
So they didn't find fraud but still stopped payment?
That's exactly why this case is controversial. It blurred the line between fraud and unconscionability, and it challenged the autonomy principle, the idea that SBLCs should be independent of the underlying contract. Lastly, let us touch on one of the biggest challenges in the letters of credit, which is fraud. Fraud is one of the few exceptions to the LC's documentary independence. Even if the document look fine, if they are forged or deceitful, banks may refuse to pay. But courts are cautious here. The strict compliance rule means that even minor typos or inconsistencies can be fatal. For example, a misspelled name or an incorrect date can justify non-payment. But sometimes relax too, just as in Irving Trust. Having said that, banks also must clearly and promptly specify all reasons for rejection, and not to forget to emphasize upon procedural fairness and the importance of first refusal notice.
What if the fraud was committed by someone other than the seller?
That's where it gets tricky. In landmark cases like Aetna and Comdata, courts said the fraud applies only if beneficiary is involved in the fraud. If the fraud is by applicant, but the seller is innocent, the bank must still pay. So the legal system protects the documentary nature of LCs, but also tries to sniff out abuse. And with that, we wrap up our journey across the three pillars: bills of exchange, checks, and letters of credit under the negotiable instruments. From the adaptable types of BOEs to slowly fading legacy of checks and the precise document-driven power of LCs, we see a legal system banking built on trust, precision, and paper trails. While technology moves fast, these instruments still anchor commercial law. Thank you very much for listening to me, and now with great pleasure I pass this baton to my well-informed teammate Adrika, who will guide you through the next topic.
Thanks, Nikhita. Hello, Nikki. Great to see you today. I am Adrika and I will be taking you through an important topic that sits at the intersection of law, business, and consumer protection: the unfair contract terms, or UCTs. Let's start with a familiar scenario. Your business is updating its banking arrangements, perhaps for a new line of credit or merchant banking facility. The bank signs over a 25-page contract filled with dense legal language. You spot clauses allowing the bank to unilaterally vary terms or terminate the agreement with minimum notice. When you raise it, you're told these are standard terms, nothing to worry about.
That's exactly what happened when we renewed our business banking package last quarter. There was a clause that let the bank charge the interest rate and fees anytime, and we were told it's just boilerplate.
And that's precisely the problem. These kind of one-sided clauses are exactly what the UCT regime is designed to address. Today, I'll break down the legal development, especially the 2023 reforms, walk you through how courts, regulators, and ombudsmen are tackling these unfair terms across industries, and how outline clear, practical steps your business can take to minimize legal and reputational risk. Along the way, my colleagues, Devina and Nikhita, will be helping me go through these cases. Before we go deeper, it's important to step back and understand why consumer protection matters in the first place. Consumer protection is a cornerstone of modern contract law, particularly when there are clear power imbalances and widespread use of standard form, non-negotiable contracts. As Patterson, Robertson, and Duke note in Principles of Contract Law, the law plays a critical role in readdressing situations where formal consent masks substantive unfairness, especially in mass market contracts, when negotiation is absent. The UCT regime under the Australian Consumer Law and ASIC Act is central to this effect, ensuring dominant parties cannot use complex legal drafting to impose unjust terms on consumers or small businesses. This framework aims not only to avoid unfair terms, but also to deter systemic misuse and foster commercial fairness across sectors. The 2023 reforms have significantly strengthened compliance obligations, particularly in sectors such as financial services, digital platforms, and essential services, where consumers are especially vulnerable. To help you navigate these documents, I'll outline the key features of the UCT regime, examine how it's enforced by ASIC and ACCC, and discuss alternative mechanisms like AFCA and e-payment code. By the end, you'll see that UCT laws just don't protect contracts, they protect trust. Because in today's economy, fairness isn't a courtesy, it's a legal obligation.
That makes sense, Adrika. But how do I know what counts as an unfair legal term in eyes of law? Are there specific criteria or charges that I should be aware of?
To understand how the law tackles these challenges, let's start with basics. What exactly is a UCT regime and why do we have it? At its core, the UCT regime is a critical part of Australia's consumer protection framework. It's designed to protect individuals and small businesses from unfair provisions in standard form contracts, those lengthy take it or leave it agreements we often come across in banking, finance, telecommunications, and tech services. These contracts are usually drafted by businesses with all the bargaining power. The other party, which is typically the consumer or small business, has little say in terms or the ability to negotiate. That's where the law intervenes to prevent one-sided or harsh clauses from being enforced. The legal basis for this regime lies in two key statutes. First, the Australian Consumer Law, which is in Schedule 2 of the Competition and Consumer Act, and second, the ASIC Act 2001, which applies similar protection to financial services and products. Under the Consumer Law, Section 23 prohibits unfair terms in standard form consumer and small business contracts. Section 24 sets out the test for unfairness. A term is unfair if it creates a significant imbalance in the parties' rights and obligations, isn't reasonably necessary to protect the stronger party's legitimate interests and would cause detriment, financial or otherwise, if it's enforced. Section 25 provides illustrative examples like clauses that let only one party vary terms, impose penalties, or limit accountability unfairly. In the financial sector, the ASIC Act mirrors the structure. 12BF bans unfair terms, 12BG applies the same three-limb test, and 12BH sets out exclusions such as terms required by law. If a term meets all these three unfairness criteria, a court can declare it void, though the rest of the contract will remain enforceable as long as it still makes commercially sense without the unfair term. Reforms post 9th November 2023. Now, from 9th November 2023, the law took a significant step towards how the UCTs are regulated. These reforms are introduced under the Treasury Law Amendment, More Competition, Better Prices Act 2022, a Commonwealth statute, and they mark a major shift from purely protective framework to the one that includes real enforcement consequences. Under the new regime, businesses can now face civil penalties not just for relying on an unfair term, but even for proposing or including one, regardless of whether it's enforced or cause actual harm. Specifically, under Section 12GM and 12GNB of the ASIC Act, courts now have expanded powers. They can issue injunctions to protect the use of unfair terms and impose civil penalties for each unfair term found in a standard form contract. The penalty amount is the greatest of the following: up to 50 million, or if the court can determine the benefit obtained, then it is 3x the value of that benefit, or if the benefit cannot be calculated, then it is 30% of the business's adjusted turnover during the breach period for a minimum of 12 months. These changes make it clear UCT compliance is no longer optional, it's enforceable.
So if a business could be penalized even if they didn't rely on any of them?
Exactly. The focus now is on deterrence, not just enforcement after harm. That's what makes this a big shift. Traditional doctrines like misrepresentation or unconscionable conduct looked at how a contract was formed, but the UCT regime asks a different question. Is the term itself unjust or exploitative? This reflects a more realistic policy approach, one that considers how contracts operate in the real world. As behaviorist economists have shown, people often don't reach 30-page contracts, especially in digital environments. So the law focuses not on whether someone clicked "I agree," but on whether they actually agreed. Another important reform is the expanded definition of small businesses. A business now qualifies if it has fewer than 100 employees or an annual turnover below 10 million. For financial service contracts, UCT protections apply if the contract value is 5 million or less and the customer meets one of the above thresholds. These changes mean that many more small enterprises, including banks and men of clients, are now protected. And critically, the enforcement model has shifted. The law doesn't wait for harm or complaints anymore. Institutions are now expected to proactively audit and update their contracts to eliminate unfair terms. Regulators like ASIC and ACCC have more power. They can apply for injunctions, seek civil penalties, and act on the inclusion of unfair terms, even if no one complains or is harmed. That's right, just including an unfair clause can now lead to significant penalties.
Wait, so even if business doesn't rely on any of the terms, it can still be penalized?
Exactly, that's what's changed. The cost isn't just legal. Unfair terms can now carry reputational risk that can erode trust and damage brand long terms. So what should businesses do? Institutions using standard form contracts, particularly in banking and finance, must now audit all contracts and avoid outdated templates, remove one-sided clauses that vary terms, limit liability or deny remedies, use clear, transparent language, ensure terms reflect real consumer and small business needs, and last, treat compliance as an ongoing obligation, not a one-off task. Now the key takeaway from this is, fairness is no longer optional, it's enforceable, and the cost of non-compliance today isn't just legal, it's reputational. Let's now look at how the UCT framework works in practice. With Nikhita and Devina, I'll walk you through key cases and real-world examples. We'll begin with the landmark decision, ASIC versus PayPal. One of the first major tests of the post-reform UCT regime that sent a clear message to the banking sector. The case involved a clause in PayPal's small business contracts known as the fee error term. It stated that if a business didn't notify PayPal of a fee error within 60 days, the fee would be deemed accepted, even if it was wrong.
Wait, so if PayPal overcharged a small business but they didn't spot it in time, they were still stuck with the charges?
Exactly. It completely shifted the burden onto the small businesses. Even though PayPal obviously had better access to its own transaction records, that raised serious fairness concern. ASIC brought proceedings under Section 12B(f) and 12B(g) of the ASIC Act in the Federal Court, alleging that the clause was an unfair contract term. Justice Mosinki found the clause unfair under Section 12B(g) because it created significant imbalance, it was not reasonably necessary to protect PayPal's interests, and it could cause detriment even without actual harm.
Did PayPal defend the clause?
No, unfortunately they did not contest the case. Instead, they made joint submissions with ASIC and removed the clause in November 2023, just as the new reforms took effect. Here's why it matters for compliance now. Since the clause was used before the UCT reform began, the court could only declare it void. No penalties were hence imposed. But Devina, what would happen under today's law?
Under the post 9 November 2023 regime, just including an unfair term can attract penalties even if it's never used. For corporations, the penalty, whichever is greater, first, $50 million, second, 3 times the benefit gained, or third, 30% of annual turnover during the breach period.
So it's not even about whether a customer complains or suffers a loss?
That's right. The law now targets potential harm, not just actual outcomes. That's why the PayPal case matters. It signals strict scrutiny even for terms that seem harmless on the surface. The key legal takeaway: even routine clauses like notice periods or dispute timeframes can fall foul of the UCT regime if they are unfair. Businesses must be proactive. Relying on old templates or assuming silence means consent is no longer enough.
And from a commercial and reputational perspective, it's a big risk. Being caught with unfair terms can lead to regulatory action, loss of trust, and long-term brand damage, especially in banking, fintech, and digital sectors.
The PayPal case is a clear warning. Even standard billing clauses can be unfair if they shift too much risk. The key message: every clause in a standard contract must be reviewed, especially when the power balance is unequal. Let's shift gear now from digital platforms to traditional banking. In the PayPal case, we saw how unfair terms can arise in fintech. Now let's look at small business lending, especially ASIC versus Bendigo and Adelaide Bank Limited. Mihir, this case shows that even standard loan agreements in traditional banking can breach the UCT regime. We will cover the key clauses the court found unfair, why they failed under the ASIC Act, and what this means for lenders under the 2023 reforms.
So this case involved loan contracts used by Bendigo and Adelaide Bank between 2016 and 2019. ASIC brought proceedings in the federal court alleging that several clauses in these standard form contracts were unfair under Section 12BG of the ASIC Act, which applies to financial products and services. It was one of the first successful UCT cases involving small businesses lending.
ASIC focused on 4 clause types: indemnity, default triggers, unilateral variation and termination, and conclusive evidence.
Let's look briefly at why each of them were problematic. Indemnity clauses. These made borrowers liable for bank losses, even those caused by the bank's own negligence. Second, the default clauses let the bank call in loans for vague or minor breaches without notice. Third, the unilateral clauses allow the bank to change or cancel terms unilaterally. And fourth, conclusive evidence clause, which made the bank's debt certificates binding unless the borrower could prove a manifest error, which is a high bar.
That seems heavily skewed towards the bank.
Exactly. The court agreed the terms created an imbalance, which weren't reasonably necessary and could cause detriment. It also criticized the lack of transparency. Many terms were buried in dense, technical drafting. Here's what matters now. UCT protections clearly apply to small business contracts. Even standard banking terms can be struck down if they are one-sided, and courts look at how a term operates in practice. not just how it's drafted. If this case had been decided under the post-2023 reforms, the banks could have faced up to 50 million per term penalty, 3 times the benefit gain, or 30% of the turnover during the breach period. So meaning, this message is clear. Routine loan terms aren't safe by default anymore. Clauses like indemnities, default triggers, and unilateral powers are all under scrutiny. And with tough new penalties, leaving unfair terms unchecked is a major leak and reputational risk. Let's now shift focus to the ACCC versus Fujifilm business innovation case. A clear example that unfair contract terms aren't just a banking issue, but can arise in everyday business contracts like equipment leases and software services. Between 2016 and 2021, Fujifilm entered into or renewed 34,000 standard form contracts with small businesses. The ACCC identified 38 unfair terms across 11 templates, which include unilateral price increase, auto renewals without notice, termination for minor breaches, charges during service suspension, one-sided indemnities, and conclusive evidence clauses. The federal court declared all 38 terms were void and unenforceable. Fujifilm, under consent orders, had to stop using the terms from 5 years, notify customers and revise its disclosures, implement a compliance program with audits and trainings, and pay $250,000 in legal costs.
If decided under the post-November 2023 UCT reforms, each of those 38 terms could attract penalties of up to $50 million per term, 3 times multiplying the benefit, or 30% annual turnover, whichever is higher. That's potential exposure of 1.9 billion, a serious financial risk.
The key takeaway here is UCT risk applies across industries, and businesses must review their standard form contracts for imbalances, unilateral control, lack of transparency, and terms buried in complex language. Today, these clauses don't just get voided, they can lead to heavy penalties and reputational damage. Let's now move on beyond domestic enforcement to ask a critical question. What happens when a contract is governed by foreign law or performed overseas? Do Australia UCT's laws still apply? The High Court answered this in Carpick versus Carnival PLC, a landmark case confirming the Australian consumer protections can apply internationally so long as there's a sufficient connection to Australia. Ms. Carpick was a passenger on the Ruby Princess, which departed Sydney in March 2020. Following a COVID-19 outbreak on board, she joined a class action alleging negligence and misleading conduct. But Carnival's standard passenger contract included 2 problematic clauses: a class action waiver requiring passengers to sue individually, and an exclusive jurisdiction clause directly claiming it to Florida courts.
The 2 key questions arose. First, do UCT protections under the ACL apply to international contracts? Second, and if so, is the class action waiver clause unfair under Section 23?
The court unanimously held that the ACL's UCT regime applies where at least one party carries on business in Australia, regardless of governing law or performance location. Choice of laws clauses do not override Australian statutory protections.
So Carnival was trying to block class action in Australia by forcing people to sue individually overseas?
Exactly. The court found the clause created a significant imbalance, was not reasonably necessary, denied access to Australian courts causing real detriment, and lacked transparency. It was buried in fine print and only surfaced post-booking. The exclusive jurisdiction was also rejected because it would fracture proceedings and undermine efficiency and justice. This case is significant for 3 reasons. It confirms that UCT laws apply internationally where an Australian party is involved. It flags class action waivers and foreign jurisdiction clauses as high-risk unfair terms, and it sends a message: you can't contract out of Australian consumer protections, especially through hidden or complex boilerplate terms. Under the post-November 2023 reforms, clauses like these could attract serious penalties, even if they were embedded in click-wrap agreements or were never signed. Here's the key takeaway from this case. If your business deals with Australian consumers or small businesses, your contract terms must comply with Australian law. Governing law clauses, foreign jurisdictions, or by fine print won't shield you. they may actually increase your regulatory exposure, legal risk, and reputational damage. So far, we explored how courts and regulators like ASIC and the ACCC enforce the UCT regime through statutory provisions and landmark decisions. But many disputes never really reach court. That's where AFCA and the e-payment code comes in. Applying these principles in real time when scam occurs, systems fail or contract term cause harm. Together, they form a continuum. The UCT regime sets the legal standard, while AFCA and the e-payment code applies these principles to day-to-day financial services. AFCA, which is the Australian Financial Complaints Authority, is a free, independent ombudsman that resolves disputes in banking and finance, including personal loans, digital payments, and small business contracts. Its decisions are binding on financial providers when accepted by consumers and may include orders for compensation, contract variations, or removal of unfair terms. Crucially, AFCA also serves as an early warning system, identifying issues like unfair termination clauses or unilateral rights before they escalate to litigation. In doing so, it prompts proactive contract revisions and safeguards consumers from ongoing harm. Now turning to the e-payments code administered by ASIC. This code governs electronic transactions like online banking, card payments, and transfers. Key protections include zero liability for unauthorized transactions where users act reasonably, limited liability where the user contributes to the loss, and defined time frames for reporting mistaken payments. Problem arises when businesses try to override these protections in their standard form contracts. For instance, by shifting all liability to consumers or restricting reporting windows. While the code doesn't impose civil penalties like the UCT regime, AFCA regularly relies on it to assess disputes and uphold fairness. Together, AFCA and the e-payment code acts as critical backstops, offering fast, practical remedies when reinforcing the core principles of the UCT regime. In June, now let's move on to one case study which I have is of the HSBC and the spoofing scam. In June 2023, a consumer, Mr. T, fell victim to a spoofing scam. He received a text message appearing to be from HSBC warning of a suspicious Amazon transaction. Trusting the message, he entered two 6-digit security passcodes enabling scammers to steal over $47,178.54 from his account. HSBC argued he voluntarily disclosed his codes and therefore bore the loss, but AFCA disagreed. In its October 17, 2024 determination, AFCA found Mr. T was manipulated under pressure. His disclosure wasn't truly voluntary, and HSBC's support response was inadequate. AFCA ordered HSBC to reimburse the $47,178.44, cover interest losses on Mr. T's home loan, pay $1,000 for distress, and contribute $5,000 to legal costs. This case is seen as a landmark win for scam victims. It reinforced that voluntary disclosure under the e-payments code must be assessed in context, including coercion and consumer vulnerability. It also highlights how AFCA plays a frontline role in protecting consumers, holding financial institutions accountable, and ensuring their standard terms are not misleading, one-sided, or non-transparent. The final takeaway from this: AFCA and the e-payments code do more than resolve disputes. They show how industry should conduct. They deliver swift remedies in scams and mistaken payments, hold providers accountable not just for what's written, but how contracts operate in practice, and embedded fairness as a standard in financial and digital services. The regulatory approach has evolved from responding to harm to preventing it through smarter design. This means fairness must be built into contracts, interfaces, and systems from the outset. AFCA's decisions are increasingly aligned with UCT principles, and even subtly imbalanced or poorly disclosed terms may attract scrutiny, regardless of whether a breach has occurred. So Mihir, here's the bottom line. In today's regulatory climate, transparency and balance aren't just good practice, they're enforceable by law. From PayPal's billing clause to Fujifilm's contract templates, from small businesses' loans to cruise tickets and digital spams, the message is consistent. Unfair terms will be challenged, old templates are no longer safe, and relying on silence or complexity is no longer a shield. Under the post-2023 UCD reforms, businesses must review every clause, remove one-sided risk allocation, and implement contract terms that reflect proportionality, clarity, and regulatory expectations. It's not just what a contract says, but how it really works in real life. AFCA, ASIC, and the ACCC and the courts are now speaking with one voice. Unfair terms aren't just lawful, they are bad business. The final key takeaway is under the UCD regime, fairness is enforceable, compliance is continuous, and trust is the most valuable clause you can offer. To briefly wrap up this presentation, Devina began by laying the legal foundation of the banker-customer relationship. She explained how this relationship is contractual but overlaid with duties of care and skill, especially in digital transactions. Her discussion on the Quincecare duty showed how banks can be held liable when they ignore red flags in payment instructions. Then Mihir explored how bills of exchange facilitate trade by providing legal enforceable negotiable instruments that support credit, reduce risk, and promote liquidity. From the legal structure and enforceability requirements to negotiation, holder and due course protections, and practical financing applications like discounting, he has shown how these instruments operate at the intersection of law and commerce. Nikhita further elaborated on various bill types, from accommodation to bank bills, and explained how liability and enforceability vary, underscoring the practical risk associated with each. Finally, I explored the UCD regime with a focus on the 2023 reforms. We have seen that businesses can now face penalties not only for using unfair terms, but even for proposing them. Through landmark cases like PayPal and Bendigo, and through enforcement mechanisms like AFCA and the e-payment code, the legal landscape is shifting. The message is clear. Fairness is no longer just expected, it's enforced. So, in closing, whether you're dealing with a banker's mandate, a negotiable instrument, or a standard form contract, the law now demands transparency, balance, and accountability. On behalf of Devina, Mihir, Nikhita, and myself, thank you for listening.